Don't wait to buy the dip today. Are you planning to buy a dip today? If yes, then wait. I think first you need to give it a second thought. Hello friends and welcome back to Crypto World. So today we are back here again and we're going to discuss the current dip. Why shouldn't you buy this dip today? And we'll discuss what would be the best time to buy these dips. So without wasting any more time, let's dive into the video. Before that, subscribe to our channel if you haven't already and click the bell icon to watch all of our latest videos. As a result of Russia's attack on Ukraine, stock prices have plummeted across the globe and in the United States alike. However, Nikhil Kamath, co-founder of Zerodha and True Beacon, does not believe that the recent correction in the stock market is the appropriate time to buy the dip. He believes that equities have not yet fallen by that much and therefore should not be purchased at this time. The markets haven't corrected that much. They've gained 100% and then lost 12 to 13%. But in terms of volatility, whenever you see 10 to 12% corrections, they have a tendency to correct a bit more than they initially did. Therefore, I would not advise you to go out and make any purchases right now. As a result of the geopolitical tension that is taking place, there is a significant amount of news that is released each hour. Consequently, I believe that people should wait and see what happens with inflation, as well as what happens with the geopolitics of the situation. I don't think the time is right yet to buy the dip, Kamath said in an interview. Buy the dip is an investment strategy. As we all know, markets are still expensive. Even at $16,300, the market is expensive when compared to any time in the past, when measured by the multiples that are used today. Therefore, it is extremely challenging to provide an accurate risk-to-reward ratio for that. I would say the risk-to-reward ratio is in your favor when markets are at, 15 PE or 16 PE or something along those lines, which is not the case right now, right? Therefore, I would say that markets are still pricey, and now is probably not the right time to try to equate a risk-reward ratio to how much valuations are. Because the impact cost of cryptocurrencies is so high and the regulatory landscape surrounding them is so murky, it is necessary to purchase sizable amounts of cryptocurrencies at each transaction. Due to the fact that the cryptocurrency market is so illiquid, I don't believe it has even come close to reaching the level where individuals can actually consider it to be a hedge against inflation and invest in it. If you were to ask me which cryptocurrency coin will still be in circulation in the year 2030, given all the options that are available to you right now, which one do you think will still be viable? I have no idea. An excellent method for outperforming the market. Some traders believe prices can be anticipated because stocks move in repeating up and down patterns that are driven by investor sentiment. However, the efficient market hypothesis suggests that consistently beating the market is an impossible goal to achieve. The investment strategy known as buy the dip originated from this theory. But what exactly does it mean to buy the dip? When looking to purchase a stock, investors who buy the dip wait until the price has fallen from its most recent high before doing so. They believe that the recent price drop is only going to be temporary or a short-term anomaly, and that this setback presents an opportunity to purchase shares at a discounted rate. People who buy the dip typically already own shares of a company whose price has decreased from a recent high. This is because the dip refers to a price decline from a previous high. Dip buyers are investors who intend to build a larger position in a stock and look to capitalize on temporary price declines, also known as dips, in the share price in order to increase their holdings of that stock. Those who purchase shares at a lower price than they originally did do so with the expectation that the stock's price will eventually recover and move higher. When an investor averages down by purchasing additional shares of a stock that they already own during a decline, they are able to reduce the net average price of their position in the stock and thereby improve its performance. The primary advantage of purchasing shares at a lower price is the long-term reduction in the average cost of the stock, but there are a lot of reasons why you shouldn't go with this strategy. To begin, it's a form of market timing, and studies conducted in the academic field of finance have shown that it's nearly impossible to accurately predict market behavior by timing one's entry or exit. Attempts to predict a decline, let alone a decline's magnitude, is very difficult. If you keep too much cash on hand, you will forego the opportunity to receive potential dividend payments, which could then be reinvestment. The practice of reinvested dividends has the potential to increase returns. Lastly, if you haven't done your research and aren't familiar with the fundamentals that underpin the company, you run the risk of purchasing a stock that has a valid reason to continue falling in value. The buy the dip strategy places a significant emphasis on risk management as an integral component. There are times when a stock's price falls for a valid reason, such as a shift in the stock's fundamental value. Perhaps the company issued a disappointing earnings report or was involved in a scandal that received widespread media attention. Any investor who is interested in buying a stock at a lower price should conduct research and investigation into the company's fundamentals before making a long position in the stock. When pursuing a buy the dip strategy, it is important to establish risk parameters. If you're going to buy the dip, then it's important to establish risk parameters. Let us compare crypto with other metals. Gold is a commodity that, on the whole, does well during periods of high inflation, which is one reason why I like it. The other commodities, such as copper, zinc, aluminum, and others, are more closely linked to the manufacturing industry, such as steel and iron ore. If interest rates go up, then demand will probably go down over time, which could lead to them correcting themselves. However, I don't think that will happen this year. Perhaps it will happen in the year after this one. When investors enter the market with a focus on the short term, it inevitably leads to problems. They want to make a lot of money quickly, but in times of market volatility and when they see losses, they want to get out of the market as soon as possible. According to the experts, this makes the market even more volatile. Volatility will not persist all the time. Given the current unstable environment across all asset classes, investing in equities ought to be favored rather than avoided as an option, Nath advised. So how should one go about investing their money at the moment? According to the recommendations of financial consultants, a prudent strategy would be to invest 30 to 40% of the corpus in equities and the remaining 60 to 70% in liquid funds or bank accounts. This money can be used to purchase stocks in a time frame of 3 to 6 months, which will result in an average price for purchasing the stocks. Investors who are uncomfortable with risk might set aside a portion of their surplus for investments in bonds, gold, silver, and other commodities. It is recommended by a manager of a fixed income fund that investors first put their money into short-term bond funds because it is anticipated that bond prices will continue to fall over the next year or so. Once bond prices have dropped sufficiently, investors may then put their money into long-term schemes. According to Navneet Damani, Senior Vice President of Commodities Research at Motilal Oswal Financial Services, an investor who is interested in investing in precious metals should put a greater portion of their capital into silver as opposed to gold. He predicted that precious metals would increase in value because of the geopolitical tensions, higher inflation, and rising crude oil prices, as well as the lack of visibility regarding how these factors should be contained. However, we expect silver to outperform gold this year. And that's all for this video. If you like the video, then like and share it with your friends. Also comment down below if you want to say anything about it. If you have any queries and suggestions to give us, just comment down below. Your feedback is always welcome by us. Also, if you want to watch more videos like this, then subscribe to our channel now and hit the bell icon to get in touch with our latest videos. And thanks for watching!